good credit, bad credit, no credit. At Dave's Auto Loans, we approve you. No, we don't. I mean, if your goal is to pick up a 2010 Ford Focus, yeah, that might work. But in the real world, credit matters. That's why today we're talking about credit scores, why it's important to maintain good credit, exactly what affects your credit score, and how to increase your credit score so you can save thousands of dollars in interest payments. What's up guys? Welcome back. My name's Dave Kim, and if you're new to this channel is dedicated to talking about personal finance for everyday people like you and me. I talk a lot about ways to save money and build wealth to hopefully provide you with some useful ideas that you can take home and incorporate into your day-to-day activities. So if you guys are interested in content like this, hit the subscribe button and drop a like. So let's get into it. If you've ever applied for a credit card or any kind of credit related product, you probably heard of the word credit score come up during the process. It's this magical number that has the power to persuade banks to finally give you that credit card so you can go to town at Best Buy. Right? Close, just missing a few details. So what is a credit score and what purpose does it serve? For those of you that are just getting started to looking into your personal credit, a credit score is a number between 300 and 900, or 850 if you're in America, that's used to rank the risk in lending you money. Prior to issuing anything from personal loans, mortgages, vehicle financing, credit cards, or any kind of credit, lenders, like banks, will use the score to assess how likely it is that you'll repay the debt on time. Based on their assessment, they'll see if you qualify for the loan in the first place, and then if you do, they'll also factor this in to determine your interest rate. So if you're like me, and you don't have $500,000 to buy a house in cash, you'll definitely want to stick around for the rest of this video. So what makes up your credit score? There's two main credit bureaus in Canada, TransUnion and Equifax. They calculate your credit score by taking into account 5 main factors. Payment history, as in how well have you repaid debt in the past? Do you have any outstanding or frequent late payments? Credit utilization, or debt to credit ratio, as in how much debt do you have compared to your overall available credit. They also take into consideration average age of credit accounts, as in how long have you had your credit accounts open for? Are you an experienced credit user or are you fresh off the block? Account types, so do you have a good mix of credit accounts? And credit inquiries, how often are you applying for new credit? Even though there's 5 main factors to your credit score, payment history and credit utilization make up 65% of that calculation. So if you currently have poor credit, these are the areas that you want to crack down on first. Now that you understand how a credit score works and how it's calculated, how does this benefit you? Having good credit can save you thousands of dollars over the course of a lifetime by allowing you to qualify for lower interest rates. The difference between a credit score of 625 and 750 can save you as much as 1% on your mortgage rate. It doesn't sound like much, but let's do some quick math. The average cost of a house in Canada is roughly $530,000 in 2020. So let's take 2 scenarios, both with the same principal amount, $530,000, and both with a 10% down, amortized for 25 years. Scenario 1, poor credit, has an interest rate of 4%, and scenario 2, good credit, has an interest rate of 3%. In scenario 1, you'd have a mortgage payment of $2,509 a month, versus scenario 2, where it's $2,257. That's a difference of $252 every month. Over the course of 25 years, that equates to $75,600 in savings, just for having good credit score. Having good credit can also give you access to more capital. Most personal loans require a credit score of at least 600 to qualify. And if you watch my video on how to pay off debt fast, you should know how personal loans can be used to save you hundreds, if not thousands, on interest payments. If you want more information on how to do this, the link's in the description box below. Check it out. So building your credit score isn't rocket science. I mean, most of the time people generate a decent credit score without even trying. That being said, there are some common misconceptions regarding credit scores that you definitely want to steer clear of. Number 1, having a good job and a high-paying salary guarantees you good credit. Well, having a high-paying job might support a bank's decision in lending you money, but it actually has nothing to do with your credit score or your credit report. Don't count on just your job to qualify you for a mortgage. Number 2, having no debt improves your credit score. This isn't entirely true either. Having no debt while still having a credit account open definitely improves your credit score. But if you have no debt because you have no credit accounts, that actually hurts your credit rather than improving it. And number 3, checking your credit score reduces it. There's 2 types of credit checks, hard inquiries and soft inquiries. Hard inquiries, like the ones that banks will perform prior to giving you a loan, will definitely affect your credit score. But soft ones, like the one that you would use to see your own credit, won't affect your credit at all. It's actually beneficial to periodically check your credit score so you know where you stand, and also to see if there's any mistakes or unfamiliar accounts on your credit report. Now that you know what not to do, how does someone go about increasing their credit score? Before you even start looking at ways to improve your credit score, you should first get a copy of your consumer disclosure from both major credit bureaus, TransUnion and Equifax. You'll want to get copies from both since they don't always have the same information, because some lenders may only send information to one or the other. Once you have your report, start improving your credit score by clearing up any accounts that are overdue or in collections. Payment history is the highest weighted factor when it comes to calculating your credit score, so it makes sense to tackle this first. I mean, would you lend someone money that has a reputation of not paying people back on time? General rule of thumb, if it goes to collections, it's going to hurt your credit. Anything from utility bills, parking tickets, medical bills, unpaid taxes, pretty much anything you fail to pay for a certain period of time, usually 90 to 80 days, will negatively affect your credit score. Also, the longer these records are on your file, the worse they are. So start by paying your oldest debt first and work your way to the newer ones. Another big factor on how your credit score is calculated is credit utilization, as in how much debt do you have compared to your total credit available. To see where you stand, simply add up the debt from all your accounts and divide it by the total value of all the credit limits. The golden number you want to keep your debt to credit ratio below is 35%. To improve this, you can either pay down your debt or increase your credit limit. For example, if you have a credit card with a $5,000 limit and you currently have a balance of $2,000, your debt to credit ratio is 40%. You have 2 options. Either pay off at least $250 or increase your limit to $6,000. In either case, your credit utilization will fall below that 35% threshold. There's a few ways you can go about increasing your credit limit. You can wait it out, since most banks naturally offer customers limit increases over time. That's of course, as long as they keep a good payment history. You can ask for a credit increase on an existing account, or you can simply apply for a new credit account. Keep in mind that asking for an increase on an existing account and also applying for a new account are considered hard inquiries, so they will affect your credit score. But in the long run, the benefits of reducing your debt to credit ratio will outweigh that credit check. Other simple ways to increase your credit include not missing payments, holding your credit accounts open to increase their average age, and don't make too many hard inquiries on your credit. If you're shopping around for a mortgage and you need to make multiple credit checks, try to keep them within a 14-day period. All credit checks will eventually show up on your credit report, but only one in the 14-day period will affect your score. So good luck, guys. The sooner you start improving your score, the easier it gets. If you're one of the younger viewers, a lot of people might be telling you to not get a credit card as soon as you turn 18. But if you can commit to using it responsibly, starting early could save you thousands of dollars in the future. So that's it for today, guys. Hope you guys enjoyed the content and were able to get some useful information out of it. If you have any comments or suggestions on future videos, drop a message below. And as always, thanks for watching. We'll see you next time.